This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
A historic week as we started a new easing cycle and the markets gobbled it all up. On this week's show, we'll look at what this has meant and what it generally brings next for your investments. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, and for the past couple of years, I've worried that I just talk too much about monetary policy. It's not that interesting. This show has a focus primarily, or we had a focus primarily on individual stocks, and for various reasons, we've pivoted away from that. With some stocks still included, but just not in the same manner. And you can be sure that this week is no different because it is a historical week in that we've now officially begun this new cycle, right? We've started the cutting cycle. I don't know exactly what to share with you about this, as I know if you're taking the time to listen to the show, well, you must already be tuned in and know the basic facts that, well, the Fed cut interest rates this week. They cut their benchmark Fed funds rate by 0.5% on Wednesday. And I guess you're here to listen to my thoughts on that and what I've gleaned from other sources, at least those that I consider worthy here. And it was interesting going into Wednesday when a rate cut was a foregone conclusion, but the discussion was how much will the cut be and what would the market reaction to that be? Ultimately, it was 50 basis points. And some said that if it was going to be 50 basis points, the market might have an adverse reaction because they might be worried that the Fed is worried and the Fed's being too aggressive. And some said this now suggests that the Fed is worried that they've acted too fast. Some that they have a long way to go to their new stated targets. And then one pundit on Thursday pointed out, and I liked what he said. He said that at their scheduled meetings, the Fed's scheduled meetings, his theory is that basically Jerome Powell laid out in his speech in Jackson Hole that they were ready to start cutting rates. In essence, there was no Fed meeting in August, so metaphorically, I guess, the Jackson Hole speech was the first interest rate cut. The markets were pricing it in wholly as if it had happened. That was the 25 basis point cut in this guy's mind. But they couldn't post it. I mean, they could technically cut interest rates anytime they want with an emergency meeting, but they really couldn't get down to business until they got to this meeting here in September. So they lumped August and September together, and here we got 50 basis points. And the immediate reaction was that the market soared. It was basically flat. Now it's 50 basis points. The markets took off. Then they sold off. Then they bounced around a bit until ultimately they finished Wednesday just about even for the day, only then to start a new day on Thursday as if the news was brand new. Now we've got time to think about it overnight, talked about it over dinner, and the markets had a tremendous day on Thursday in reaction to that very same news. And where we are when I stepped in to record this, and frankly, I guess I wouldn't be shocked to see the market lower by the time I stepped out of here, but the markets were very strong today, up about 2% since before the announcement of this cut, this new plan. And the S&P 500 and the Dow Jones Industrial Average are today at all-time highs. So take that into consideration. We had that little, really what I think, overhyped panic back in August, largely forgotten now a few weeks later. We've had a lot of fears. We've had a lot of headline issues. But the market is at an all-time high. And because it's climbing that valuation higher and higher, it is just that much easier to break something if we slip and fall somewhere ahead. But my first conclusion today is that instead of guessing at what the Fed means by cutting 50 basis points instead of 25 basis points, we should start with the basic knowable facts, which is that the Fed cutting the benchmark rate by 0.5% adds that much more of a boost to the economy and injects that much more liquidity and allows valuations to edge up that much more, all other things being equal. So market was already pretty expensive, you might say. Market was already near its all-time highs. That was pricing in 25 basis points. Now we can go just that much higher in whatever mathematical formulas are pushing this boat around. One effect it has is that it starts pushing a lot of cash back into motion. According to strategists, the American consumer has a ton of cash, up to $18.4 trillion in consumer cash out there, up from $13.3 trillion at the end of 2019, right before COVID struck. But what really jumped off the page from that report is that it wasn't a case of this cash hoarding or people getting better returns on cash or getting checks from the government and keeping it in cash, but that total consumer assets in the United States rose from $133.8 trillion to $184.5 trillion. It seems like a crazy number. I got to really recheck where they're getting this. That seems like a lot. But regardless, citing their report at least, it's rising the same percentage, the total assets, as the cash. And that's really a measure, though, of consumers' ammunition, their health, their ability to spend. And there's plenty of that out there. But on the other hand, actual money market holdings in the U.S., this is more a representation of investable savings. That has also soared since the pandemic, where it was actually spent down early in 2020 to historically low levels, if you look at where money markets have been over the last 50 years. And this is not inflation adjusted. It's on absolute dollars, so there's some of that to take into account. But cash got spent down very quickly, very early in 2020. And then, of course, it soared. We started getting checks from the government. We stopped doing much else in life. Stayed at home, got our groceries delivered, and we got over $25 billion in money market, about 30% higher than not 30% higher than where it was in the beginning of 2020, but we got to a peak of $25 billion in money markets. That was 30% higher than at any previous peak over the last 40 years. So it was a big number. And that may on its own seem counterintuitive, as this is when inflation started picking up. The inflation is literally the devaluation of the dollar in many respects. The dollar is buying less. So why would people be accumulating cash? Well, because the available interest rates quickly started to exceed the prevailing inflation, and the money flooded in. People were getting 5-ish% or more on money market, and it was a great place to store money for a long time. And we should expect to see it now starting to seek different homes as those mid-single-digit yields are going to start to erode. I would expect to see, if not by before the weekend, at least next week, some of these interest rates on stated money markets to be cut. And investable dollars are going to start looking to lock in yields, either in fixed assets at what are still relatively high rates relative to the last 10 to 20 years, or find a home in other risk assets like stocks. But back to where we are today, we're left with a Fed that has now officially changed its policy. It went from tightening to a period of pausing. I don't have the actual factoid here, but it was like the second largest pause over the last 100 years or something like that. So a period of pausing, not doing anything, to now a cycle of loosening interest rates. And per one economist I saw interviewed this week, he said, we're, quote, looking for a destination and a speed of travel, end quote. And the markets are going to be reacting to data and pricing in how fast we'll approach the Fed's now terminal rate or the neutral rate. And we'll be looking at what that rate actually is and what that destination ultimately is. That's the terminal rate. The destination is the terminal rate. You know, the Fed can set forth on this course for that terminal rate in their statements, and they stated out there, said that our new terminal rate is 2.9%. And they gave us an estimate of how fast they may get there. But whether that terminal rate is an actual neutral rate is debatable, because the neutral rate doesn't have a formula. The terminal rate is a guesstimate of what that is. So they're sort of the same thing, but not exactly. In their statement on Wednesday, the Fed raised that the estimated neutral rate is now 2.9%, up from 2.5%, where it was at the beginning of the year, and it had been pegged at for many, many years. So as many economists have argued that the neutral rate is higher, and have been arguing that it's higher than many have expected, well, the Fed is starting to follow along, raising their terminal rate up. And why this matters is, if it really turns out to be an accepted rate at somewhere mid 3% area, 3.5-ish%, well, then we don't have as far to go from here as we may have thought. As another person said on CNBC this week, we may be coming in for a soft landing, but we're landing at a different airport. And as this neutral rate starts to tick higher, it's evidence that the era of near zero interest rates may be behind us. And along with that goes the period of time when we all were enjoying, hopefully, 3-ish, maybe less than 3% mortgages and a bunch of other costs, including the cost of our national debt. Meanwhile, the economists here who said that we'll be searching for a destination and a speed of travel went on to say that if we don't get them, quote, we'll be in for a long and irritating ride, always wondering, are we there yet? And we'll be stuck with a nonstop debate arguing that point, end quote, which is basically my fear, is that we'll be putting out years and years worth of podcasts and material still focused largely on monetary policy. We'll be too afraid to talk about the politics of fiscal policy or the disclosures and dealing with the disclosures of talking about specific investments, so it'll become a monetary policy show entirely. But for that pundit on CNBC, I hope he at least found comfort that Chairman Powell did lay it out pretty plainly. He came out and he said they have their 2.9% rate now. That's the destination marked. And the rate at which we're going to get there is mapped out pretty well also. As Powell went on to say, we should expect another 50 basis points this calendar year, which will probably come in November, and that we should expect another 100 basis points, another full percent cut next year, getting us to a rate then of about 3.4%. That will still be, at that point, a bit higher than the stated terminal rate, but it's within striking distance. And this is based upon the Fed chair on what he called a widely accepted consensus for expecting economic growth of about 2% annually into 2027. And he went on to add that the risks right now are basically the risks to both sides of the Fed's mandate, full employment and stable prices, that those risks are now in balance. So if rising unemployment is as much of a risk as rising inflation, then we surely should get close to that neutral rate sooner than later, as long as you don't get both rising at the same time. However, keep in mind, with this last thought before I step away for a quick break here, the Fed's mandate is stable pricing, not cheaper prices. They say we say they fight unemployment and inflation, but they say we seek stable pricing in the economy. They are targeting an economy where the balance of goods and services that we buy, excluding food and fuel, will go higher by about 2% each year. So don't look to any of this to bring prices for these core items back to where they were 5 years ago, because that is just not part of anyone's reasonable calculus here. What it does mean, according to a Wall Street Journal article from Wednesday night, is that, quote, after 4 years of upheaval, the U.S. now seems to have low inflation, low unemployment, and solid economic growth, end quote. In fact, the article, which is written by Greg Ip, went on to make my point by saying, quote, normal doesn't mean idyllic. Some people will be unemployed. Some people's wages are not going to keep up with inflation. Prices won't go back to where they were, end quote, et cetera, et cetera. But since this is a podcast about investing, that's a description of a stable, growing economy, one which will incrementally be adding liquidity as we venture forth on this part of the cycle with lower rates. And that's a description of an economy that's very good for stocks. All right, after a good quick break here, I'll be back with more on why this is all good for stocks and maybe where within that to focus. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a minute.
Will the Magnificent Seven continue their spectacular run? Be careful relying too much on last year's playbook. Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about some of the most important planning topics to consider and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. You can go out and argue amongst yourselves, but the job of the Federal Reserve is to manage the monetary policy for our central bank so that we can achieve maximum employment with stability of prices in the economy, as I was saying before the break. Moving the Fed funds rate is their primary weapon to achieve these goals. They have a few other tools in their shed or arrows in their quiver, but by lowering that rate, it moves the needle now towards supporting employment more than fighting inflation. But my reason for saying this all over again is that what's not unique, but a bit unusual this time, is that over the past 100 years, the Fed begins lowering interest rates almost always. There's exceptions to this, but typically they start cutting rates right as the beginning or in reaction to the beginning of a recession. So while you can agree or you can make a face right there, this time the Fed appears to be taking the pressure off of the economy when the economy is already or still actually doing well. And by the Fed's estimates, and I do take them at face value, they're doing this in an economy that they expect to grow at an annualized 2% rate. And it'll be interesting to see what this means for various asset classes. For the last three interest rate cuts, first interest rate cuts of the cycles, various respective cycles, the S&P 500 was actually lower 6 months later than the day of that first cut. For the one before that, from July 1995, when Greenspan was really working to keep the party going at that time, and it did up until 2000, well, the market kept heading higher. But for the other three, the three most recent, the markets were lower. A brief exception was a cut from July of 2019. The market actually headed higher, but of course, if you actually do it point to point 6 months later, we were right at the start of the pandemic, and the markets were pretty bad in the first quarter of 2020, only to be substantially higher 6 months later. The point, though, is that the Fed cuts interest rates at times like this one when it's headed back to neutral and the markets have done well. And the Fed has cut interest rates at times when it's already at neutral and it needs to take actions to support what's otherwise a deteriorating economic condition. And what's interesting is that when looking into the data now, I expected to find in the data that small caps, small companies, would be bigger beneficiaries of interest rate cuts, especially in an interest rate cycle that doesn't include a recession. These are the companies that, relative to the big mega cap companies, the small ones typically carry more debt, and they certainly have to pay more to borrow it in the first place. And the earnings of the small cap Russell 2000, the earnings itself is more volatile than the constituents of the S&P 500 and trades at lower multiples to those earnings. So the basic logic here, which fails us once again, would lead us to suspect that they would really love the effects of lower interest rates, even more so than the S&P 500. Now, they do, on a relative basis, do better. They prosper or benefit from lower interest rates. However, over the past 40 years, while they may have done well, the small caps actually lagged the large caps in 5 of the 8 rate-cutting instances based on their performance over the next 65 days, according to a study that Strategists put out last week. Now, they too see these smaller companies would be suffering worse from the cutting cycles during recessions, but even during what they pointed out as a soft landing in cut in 1995, the indices were basically even. They were up about, both of them, Russell and the S&P, were up about 6% 2 months after that first interest rate cut. In a similar article was put out by Liz Ann Saunders, she too pointed out that small caps did not outperform. And in fact, in that article, which was titled, "It's Time for a Fed Pivot," so a lot more she had to say there about what the Fed was at the time about to do. It was during cuts when there was a recession that small caps actually outperformed the large companies over the year after that first interest rate cut. Now, I'm not out on a limb here because in that article, Saunders also says that this is against the conventional wisdom and concludes by saying that if you're inclined to move some capital into small holdings, into smaller capitalized companies, then focus on quality. And to me, that seems like common sense. But she points out that over the past year, in which this past year small caps have done pretty well, it's the profitable members of the Russell 2000 that have significantly outperformed the unprofitable members. And that, to me, also seems like common sense. But I've made the point many times over the many years that one needs to be careful when you're looking at the metrics and the measures of the Russell 2000 because the Russell themselves, when they list valuation metrics for the index, they just zero out the many numerous constituents who are not profitable as opposed to averaging all their earnings together and netting out the negative earnings. They just don't count them. So valuation metrics can be very misleading there. I would simply add to this all two final thoughts for this week, this historic week here. The conditions are set so that the S&P is in position to outperform the current earnings expectations for the next year. But it's also somewhat priced in for this to happen. Now, it can't be that much because the expectations are the expectations. So there's a lot of experience and education collectively being put together to come up with these consensus estimates. But the conditions may be ripe for them to outperform, but it's already trading at about 21 times next year's earnings estimate according to FactSet. And to achieve that number, I think it's about $281 for the S&P to earn over the next year. It would also require record margins on top of the expectations for top-line growth. So as Ms. Saunders suggested, focus on quality and don't chase what might otherwise get a bit frothy going on from here as we get this monetary stimulus. And lastly for this week, as we do here start to push benchmark interest rates lower and the overall yield curve starts to normalize as it's already moving back to not an inverted curve because the longer end of the curve is not coming down as fast as the shorter end, 10 years yielding more than the 2-year. I don't know. I mean, they always say that an inverted yield curve is an indicator of recession, and then people take that to mean that it leads to recession as opposed to as a sign that one might be coming. But now we've moved away from it. Again, maybe avoided that recession. However, I'll point out just one more factoid I got from Securities this week, as not only might mortgages not come down as much as you might expect, not revisiting those 2020 type low levels of mortgage rates, but overall longer-term interest rates may stay higher than they've been for most of the past 15 years or so. And Strategist points out that more than 55% of America's national debt is maturing over the next 3 years. And the current yield on our debt is about 3.5%. And the cost of the interest on national debt is already approaching parity with our entire defense budget. So it's going to be pretty expensive, much more so in the coming years. That's all for me this week. I hope this time that you spent was helpful and worthwhile for you. And if it was, if you found it to be helpful, I hope you share it with someone who probably hasn't heard from us before. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.